Welcome to The Explainer. Today, we're going to tackle what might be the single most dangerous piece of advice in all of trading. It's a rule that sounds so smart, so logical, but it could be quietly draining your account.
I mean, you've heard this 1,000 times, right? It's like the first rule in the trading playbook. Always risk $1 to make 2. It's pitched as this golden ticket to making money in the markets.
But here's the big question. Does this rule actually guarantee you'll make money? The short answer is a big, fat no. Actually, if you follow this rule blindly, it can be a recipe for disaster, for consistent losses. So let's get into it and unpack the real math.
All right, so here's what we're going to cover. First, we'll bust this magic ratio myth. Then we'll look at the profit equation that really matters. We'll talk about some common traps traders fall into and how to start thinking like a pro. And finally, we'll build a personal framework to help you find your real trading edge.
Okay, first things first. We need to get on the same page about what this risk-reward thing even is. Because, its incredible simplicity is actually its biggest trap.
So on the surface, it's just basic math, right? It's the potential reward you expect for every bit of risk you take. For example, risking $100 to potentially make $200, that's a 1-to-2 risk-reward ratio. It seems so logical, so safe, profitable even. But, and this is a huge but, this is only one piece of a much, much bigger puzzle.
And this right here, this is the core truth that so many traders miss. The market does not care about your formula. A ratio is just a number, and without its other half, the crucial part, your win rate, it's pretty much useless for figuring out if you're actually going to make money.
Okay, so if the ratio isn't the whole story, then what is? Let's dive into the math that's going on behind the scenes, the stuff that really separates the winning traders from the losers.
And that brings us to this concept called expected value. All this really is what a trade is worth on average over the long haul. And there it is, the missing piece of the puzzle we've been talking about, your win rate. See, how often you win is just as important, maybe even more so, than how much you win when you're right.
This chart really drives the point home. Check out these two systems. Both of them have that golden 1-to-2 ratio that everyone talks about. But look at System 1. With a 50% win rate, your expected value is positive. You're profitable over time. Now, just glance over at System 2. The only thing that changes is the win rate drops to 30%, and suddenly the expected value is negative. That system is a slow, steady account killer. The exact same ratio, but completely different outcomes. Wow.
So now that we see how critical the win rate is, let's talk about some of the really costly mistakes traders make when they get obsessed with just the ratio.
Yeah, there are 3 big ones. First, you've got traders chasing these massive ratios, like 1-to-4 or 1-to-5, but they completely ignore that the probability of a trade like that actually working out is super low. Second, they'll set these totally unrealistic profit targets, stretching them way beyond any logical resistance level just to make the ratio look good on paper. And what happens? The price comes close, reverses, and boom, they get stopped out. And third, and this is a big one, they ignore the market context. A huge risk-reward ratio doesn't make any sense in a market that's just chopping sideways. You have to remember, market context will always beat a simple ratio.
So, how do we get around these traps? Well, it takes a totally different way of thinking. We need to shift our mindset away from the amateur who's just focused on a perfect number and start thinking like a professional trader who sees risk and reward in a completely different light. And this right here is the fundamental shift. The amateur asks, hey, is this trade giving me my 1-to-2? But the professional asks, what's the probability of this trade actually working? You see the difference? The pro is assessing reality. They're prioritizing the chance of the setup playing out based on what the market is doing right now, because they know the ratio comes second to the likelihood of being right.
And you know what's really fascinating? The psychology of it all. Look at System A. You've got a 70% win rate, but just a 1-to-1 reward. This means you're getting lots of consistent, smaller wins. That feels good, right? It builds confidence. Now compare that to System B. That 1-to-3 ratio looks incredible on paper, but with a 30% win rate, can you mentally handle taking 7, 8, maybe even 10 losses in a row just waiting for that one big winner to come along? For most people, that's brutal. Your own emotional tolerance is a massive part of this whole equation.
Okay, so here's the bottom line. We have to get away from this rigid one-size-fits-all rule. Instead, we need to build a flexible framework that's actually tailored to your specific strategy and, just as importantly, your psychology. So here's a practical 5-step blueprint to do just that. Step 1, you have to know your actual win rate.
And I mean with real data from at least 30 trades, not just guesswork. Step 2, use that win rate to figure out the bare minimum ratio you need just to break even. Anything above that is pure profit. 3, adapt to the market. Stop trying to force a huge home run trade when the market is just going sideways. 4, manage your position size. Risking a small fixed percentage like 1 or 2% is what will keep you in the game during those inevitable drawdowns. This part is absolutely non-negotiable. And finally, step 5, you've got to track and review everything every single week to find those emotional mistakes that can just wreck an otherwise great plan.
All right, so we've got a solid framework now. But let's talk about the final piece of the puzzle. This is the thing that really separates the good traders from the truly great ones. It's an edge that goes beyond any numbers you can plan out before you even enter a trade.
You see, the hidden edge is all about adaptive trade management. The best traders, they don't just set it and forget it. No way. They are actively managing the trade in real time. So let's say a trade moves halfway to their target. They might sell half of their position right there, locking in some profit. Then they'll move their stop loss up to their entry price. What did they just do? They made their risk-reward completely dynamic. They've literally just created a risk-free trade with the rest of their position.
And this quote just nails it. The best traders don't obsess over single trades. They focus on the next 100. This perfectly captures the professional mindset. Any one trade is just a single data point in a long series. The goal isn't to be right on this trade. The goal is to execute your system with discipline over and over and over again, over a large sample size, and just let your statistical edge do its thing.
So, if there's one thing you take away from this, it's this. Stop thinking of risk-reward as some magic formula. It's not. It's a mirror. It's a reflection of your own psychology, your discipline, and most importantly, your actual edge in the market.
So I'll leave you with a final question to really think about. Is your trading built on a simple rule that just feels safe? Or have you actually done the hard work to build, to backtest, and to execute a strategy that gives you a genuine statistical edge over the long haul? Because that's the difference that really, truly matters.